Okay, great. Hello again, everybody. This is Harry Boxer of the TradeOutLoud.com. As you can see from my profile there, I've been doing this a bit, more than half a century. I've been doing technical analysis since I'm a teenager. I'm now in my 70s. I have a room called the TechTrader.com with hundreds and hundreds of people in with me every day. I'm doing live 1-minute day trading charts. I wrote a book called Profitable Day in Swing Trading, and the Stock Traders Almanac ranked it as the best new investment book of the year for 2015. I'm a chief technical analyst from several brokerage firms prior to doing all of this years ago. I've been on CNBC, CBS, Market Watch, Winning on Wall Street, stock, you name it. I've been on it, and I speak at money shows and trader expos nationwide, and I've been doing that for over 25 years now. The one thing I've come up with, folks, that after 1999 and the dot-com crash, I realized that holding stocks overnight can be dangerous and not good for your portfolio. When I drilled down to 1-minute charts, I was amazed to see that patterns form in all time frames. Now, if you read the book Technical Analysis of Stock Trends by Edwards and McGee, the Bible of technical analysis, it basically shows you patterns that are forming in all time frames. But that book was mainly used for daily charts. I found out that the same patterns work intraday trading in 1-minute patterns. Profitably day trading using those 1-minute charts and using 3 or more indicators that I follow that are basically chart pattern indicators. They're called continuation patterns, such as bull pennants, coils, flags, etc. Okay. From beginners to professionals, stock chart patterns play an integral part of analyzing market trends intraday and predicting movements. They're very, very important tools, folks. I'm a big believer that the patterns predict or show you what's going on internally, and they're always in advance of the fundamental news. That's why they say, buy the bad news, sell the good news. Oftentimes, the stock will anticipate both ways. And also, the other thing you can always count on, the market and individual stocks will always go further than you think they will, both up and down. So never try to catch a falling knife or stand in front of a runaway freight train. I tell that to my traders every day. Do not short a stock that's spiking and running. You wait for the pattern to develop, a reversal pattern to develop, and you go with that. One thing I found out that if you look at what a chart pattern represents, it's basically an interpretation of the supply and demand and the action between buyers and sellers. And patterns that I use are either one of two things. They're always continuing the prior trend or they're reversing the pattern. So there's really only 2 types of patterns: continuation patterns, reversal patterns. I'll show you examples for the most part in this presentation. And then after we're done with this little PowerPoint, I'm going to go to today's charts and show you stocks that we traded today based on this stuff, so that you can get a real feel for what I'm talking about. I wouldn't say live, but it's as current as you can get being from today's trading. And you'll find that these patterns are recognizable. Now, I'm a big believer in pattern recognition. I kind of have a photographic memory. And when I see something, I immediately see the pattern before even drawing the lines. But what I do for my traders every day when I come in early in the morning at 3:45 Pacific Coast time, I'm on my site. I'm going through hundreds of charts and patterns and picking out and creating what they call a focus list for my group. The focus list consists of 8 to 10 to 12 stocks, something like that, of what I consider pre-market patterns that are very, very promising for an extension during the trading session. And during the pre-market session, if you're with me early, you often can make a lot of money even before the market opens in a pre-market pattern, because some of them, especially the lower price stocks, really tend to fly and move in big percentages pre-market. So moving forward, basically patterns develop, and why it matters to identify them is that you'll get a competitive advantage in the market. You really will. Using them will increase the value of your future technical analysis, and you'll be able to spot patterns, and you'll be able to make a lot more money. If you come in my room, they say that 2 months in my room is like 2 years in the classroom. It's because I thoroughly explain the patterns as they're developing, and it's like being in a class with me every day. I love teaching, and I love hearing stories about my members who've paid off their homes and bought a Ferrari, and I have one guy who bought an island in the Pacific, believe it or not, he made $3 million trading with me. Anyway, let's move on. I want to show you some patterns. Again, like I said, there's continuation patterns, and then there's reversal patterns. And in order to interpret the trend as up or down or sideways or consolidating, these patterns will give you a feel for which way the market's going. A continuation pattern, once again, I want to be clear on this, is a pattern that forms, that indicates that the prior movement before that pattern formed will continue in the same direction, meaning it goes up, it goes sideways, and then it'll go up again. And you know one thing is for sure, stocks don't go straight up or straight down. They'll stop, they'll pause, they'll consolidate, they'll pull back, they'll retest. And they'll do that kind of action every day. You'll see stocks, and I'm going to show you examples a little later on. Now, the reversal patterns is something that happens that suddenly changes something. Whether we see a stock or a pattern moving up in the direction where the market's suddenly reversing, or the pre-market, you're getting some indication that's occurring. More importantly, the underlying indicators, such as on-balance volume and any kind of oversold oscillator that is basically not confirming the trend, is an indicator that there may be a trend reversal. And then watching the patterns break and get under a certain level of support, be it the trend line, a moving average, or a combination of factors, lateral price support. When they start to reverse, that's when you buy or sell. You don't buy or sell trying to pick a bottom or top. It's absolutely dangerous work, and it's not good for your portfolio or your financial health, that's for sure. So one more time, a continuation pattern occurs during a stock price trend, and they're a visual representation of a consolidation or a period of rest, where a stock is basically digesting the move. And normally, my experience is over the years, and I've obviously been doing this a lot of years, that the price pattern that forms is maybe a stop on the way up in a stair-step manner. Stocks tend to move in 45-degree angles, believe it or not, from your lower left-hand corner to your upper right-hand corner. Just the way it is. It's amazing that over the dozens of decades or multiple decades I've been doing this, that stocks continue to form the same patterns day after day, week after week, year after year. Edwards and McGee wrote that book, Technical Analysis of Stock Trends, in 1948, and there's been 11 subsequent editions, revisions, and new editions that basically update certain things, like, for example, AI or automated trading, computerized trading, things of that nature. Obviously, the increase in volume in stock trading when I was a kid literally traded, the market was trading 5 to 10 million shares a day, million shares a day. Now it trades that in seconds, and it's trading billions of shares a day. So, it's a whole different ballgame. The basic patterns that I follow are pennants, coils, flags, and in the pennants also with triangles and coils. They're very similar, different widths and different sizes, but they all are continuation patterns. And, always be aware that when you're looking at a pattern, and my historical analysis has shown me that no matter how good a pattern is, it's only good 2 out of 3 or 3 out of 4 times, depending on the kind of pattern. Not only is the pattern important, but the volume that goes along with that pattern must be something that's drying up. In other words, towards the end of that pattern, before it breaks out, you'll notice almost every time, and I'll show you lots of examples later, a stock will form a certain pattern. It'll get very quiet. The volume will recede, and it gets to a point that I call the low volume ebb. Just like when the ocean goes out, and the tide goes out, I should say, and stops for a second, and then that's called ebb tide, right? Then it comes back in again. That ebb tide in stocks is what the low volume ebb that I call it. And it's always a point of buyers and sellers coming to a head, matching, stepping back and waiting to see who's going to make the first move. And oftentimes it's a precursor to an important move up or down. Now, again, I want you to be aware that prices break out in the wrong directions between 25 and 45-50% of the time. So the technical indicator is good most of the time, about 2/3 of the time. But that's reliable enough for you to make a lot of money. Again, there are 7 chart continuation patterns. You have your flag pattern, which actually looks like a pole on a spike up on the price, and then sideways movement with tops and bottoms kind of looking like a flag. A pennant or a coil pattern is something that gets narrower and narrower and narrower as that pattern is developing, and it comes to what I term the apex of that pattern, where there's again a different buyers and sellers come to a head, so to speak, and that's when the stock usually gets some volume one way or another and indicates the potential for that continuation of that prior pattern. Now, triangles form either ascending or descending, and I'll show you the significance of them a little later. Rectangular patterns are pretty much flags or trading ranges. A falling wedge pattern is a very bullish pattern, believe it or not, if it occurs in an uptrend. Many times when you see a wedge as the stock comes down, it's similar to a pennant, only it's in a falling pattern, and it comes down to the apex for moving. I hope that's not too confusing for you, but I'll try to show you some examples that should alleviate your fears or lack of knowledge of what I'm talking about. A rising wedge pattern in an uptrend can often create pullbacks. Just typically, a pattern, a flag pattern, for example, moves up, backs and fills in a downward mode or sideways mode, and then continues in the upper trend. Buyers and sellers come to a meeting of minds, and they're, like I said, they're all waiting. And when price breaks up, you want to see volume break out as well. A pennant is something similar to a flag, only gets narrower and narrower and narrower and narrower. In the first move up, the second move gets narrower and forms that little pennant, and then they break out. In a bearish pennant, you're in a downtrend, the stock comes down, it forms a pennant, and then resumes the downtrend. So you want to, these are very, very popular patterns that a lot of traders, when they see them, they'll jump as soon as that stock breaks out of the flag. Again, I'm going to just repeat this one more time. There's 7 types of patterns: flag patterns, pennants or coils, ascending or descending triangles, and then the rectangle pattern and the falling or rising wedges. And you get your pennant. This is what's called an ascending triangle or an ascending coil pattern. The reason why it's ascending is the bottoms are ascending. Usually the tops are flat. But when you get a breakout, it's coiling, 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 it breaks out. Usually when it gets to the top, that's a buy signal. And it will drive the stock higher in a continuation pattern. And these occur a lot during the day, and I'll show you some examples when we're done with the initial presentation, as I said. And here's an example, not an example, but a rough drawing of what a descending triangle or coil pattern is. Stock will come down, coil, but it's descending because the tops are descending. This is bearish in a downtrend. It usually breaks to the downside. I saw a couple of these in the indexes over the last couple of days too. A rectangle pattern is simply what it sounds like. My stock moves up, goes sideways in a tight pattern where tops and bottoms are at the same level, and then they break out. On a downtrend, the exact opposite occurs. Sometimes they're referred to as channels, where stock will move in a narrow channel. Sometimes it's a wider channel. The key is to break out above or below that as an indicator of directional moves. And usually they occur in bullish and bearish trends. So if you see a run up in a stock and it does this, on a wider range, it's called a rectangle pattern or trading range. Much narrower, they're referred to as flags usually. The price will normally break out in the prior direction, and that's why they're called continuation patterns, because they continue the prior trend. The falling wedge pattern, as I said to you, is very bullish in most cases. They usually will create a movement up, falling wedge with narrowing prices. But when they break out, particularly if volume picks up, you want to be on it because we usually get a quick move, and it's great for scalping as well. The rising wedge comes in, oftentimes you'll see a rising wedge fail, because what it basically is, it's losing momentum. And so you usually want to see that and how it reacts when it comes down, and whether or not it, for example, will hold pullback lows or not. And if it goes lower, this could be a trend reversal pattern as well. Again, reversal patterns indicate the end of an existing trend, up or down. It indicates a reversal or end of selling in the case of a downtrend, and the onset of buying are exact opposite in an uptrend. Two major ones we see, and by the way, I'm just going to point this out. One of the most misused terms I've ever seen in trading is head and shoulders. Very rare are head and shoulder patterns. When they occur, they're very powerful. But when patterns are often formed that look like head and shoulders, or sometimes it's actually bull wedges or bear wedges. And don't ever consider something a head and shoulders pattern that's completed until the neckline of that breaks. The neckline is simply, I'll show you in a moment. Here's an inverse head and shoulders, and here's a regular head and shoulders. Why is it called a head and shoulders? Well, obviously, kind of a head with a shoulder on each side. They are considered the most predictive of all chart patterns. They really are. Because when you see a major downtrend that ends with this kind of a pattern, an uptrend that starts to get through the neckline, this is called the neckline right there. The shoulder line is there. Head and shoulders top comes up, pulls down, makes a higher high, then makes a lower high and rolls over. It takes out the neckline. That's what this is called. When the neckline is broken, the trend is reversed, particularly when it comes with increasing volume. I often tell my people, when you see this kind of a breakdown, wait for the first pullback. If it doesn't get through the neckline and then starts lower, that's an excellent shorting point. Conversely, in a reversal off of a low, when the stocks come down, 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 and forms this pattern, then breaks out, the ideal scenario is to wait for that first pullback. Often the moving averages will be coming curling around and crossing over. And when you see a breakout, the pullback to the crossover moving averages and neckline, and it holds it and then starts to move up, probably the best buying point on an intermediate to long-term chart that you can get is that point when it retests and then starts to move up again. So reversal pattern accuracy, they're not as accurate as you think they are. They're on the order of 67 to 75%. But again, it's an edge. It's better than 50%. And if you can trade, look, anybody that tells you that they do 80, 90, 100% trades, they're lying to you. There's a lot of naysayers in the world that are out there telling you they have the golden goose, the magic program, the secret sauce, whatever you want to call it. And a lot of these people have 4 or 5 years trading, if at all, and they're out there, but they're really good at making videos. So that's what you got to be aware of when you're out in the world. A guy like me has been doing this 50, 60 years now, and trading with hundreds and thousands of traders over the last 25 years. I can tell you that what really works is accurate technical analysis. For me, technical analysis is the perfect science. The problem is there's human beings interpreting it, and their emotions and their decision-making on those patterns are what gets in their way and why they fail, even with the charts right in front of them. People do not know how to protect themselves using stops and sell when you reach a target. I have lots of philosophies I can talk to you about today, but we're limited in time. I do want to move on and show you some other things. Indicators like the breakaway gaps, continuation gaps, island gaps, exhaustion gaps. People use gaps very wrongly. They misinterpret gaps. First rule I hear all the time is, oh, that's not gap down there. It's got to fill that gap before it goes any further. Guess what? That's a falsehood in technical trading. Gaps don't need to be filled. Sometimes they're filled 5 and 10 years later. Sometimes they're never filled. Filling a gap is fine if it holds that gap and moves back up again. But the fact that you think or someone says to you, it's got to fill the gap or it's not going any further, is an absolute 100% falsehood. Here's a couple examples. You see this gap? And what did it do? It just kept going, 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 going. It never filled that gap. That's, again, when gaps are powerful because they're an indicator that price jumps across resistance, leaving a gap behind. And that's often an excellent time to buy a stock, particularly on the first pullback if you get one, and consolidation right there. And stocks will move in Elliott wave, 5-wave fashions. Here's 1, 2, 3, 4, 5 before a bigger pullback sets in. And even that pullback was a 1, 2, 3, 4, 5-wave Elliott wave move, back up again. But again, when demand for a stock like a new major contract, an FDA approval, whatever the news is, if it's going to affect the stock, particularly overnight or in pre-market trading, and you see a major gap up, what follows that gap is what I look for every morning. Coils, patterns, triangles, consolidations that are indicating this is just a stop on the way higher. And now you're not going to catch every bottom and catch every top. My goal is to catch a big chunk in the middle every day for my traders. And I'll show you lots of examples from today about how that occurs. So you can use breakaway gaps as an indicator because they're very bullish or bearish if they break down. And as I said, there's just a few kind of gaps. Here's another example of a continuation of running gap. Has this thing ever filled this gap? Look at this. Gap, 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 and all the way up until finally it exhausted itself. If they're exploding, how many times have you seen a stock do this and say, "Yeah, this stock is overbought. I'm not buying it." It keeps going, keeps going, keeps going, keeps going, and then you buy it up there. That's the average public guy. He gets sucked in at the top after he just can't stand it anymore. I got to buy it. Like, you know what I mean? That's usually the time. Like when you get too excited about something, I have a rule of thumb in my room. I tell everybody, when you hear yourself mentally or verbally say, "Go, baby, go," that's 100% of the time you should be selling the stock. Or when a stock is getting crushed and you feel like you want to go to the bathroom and throw up, that's the time to buy. It's exactly the opposite of what you should be doing. Okay, but you buy, you buy the usually I don't necessarily buy the breakdowns. I short the breakdowns and buy the breakouts. Again, especially if there's a gap. So this is my little spiel before I get into the rest of the presentation. You can come to the TechTrader.com, TheTechTrader.com, and sign up for a free trial for 10 days, and I think you'll really enjoy what you see. It's a great place to be, a great community with some very smart traders that are mentors as well. That's my little spiel, but now I'm going to show you some presentations of stocks from today that really worked out well. Here we go. In the morning, I came in and I spotted POAI. I want to show you something. This stock was going nowhere. We call this a line formation. Look at the volume, non-existent. Suddenly this occurs. So I usually go back in time and give you examples of what happened and when. Here we go. The stocks exploded and pulled back and formed a wedge. Note the volume on the breakout. This little line here is what we call on-balance volume, and it's showing that even during this pullback, it was being accumulated. I always watch for that. What happened then? That wedge or bull wedge broke out and exploded vertically. Then formed another wedge and broke out. It pulled back and tested, it kept going. It then formed a little pennant. Was it done yet? Nope. Eventually, we got up to 266. We got in under $2, like in the 185 range. I then told everybody, look, when you see 5 waves up, 1, 2, 3, 4, 5, it's dangerous to stick around without stop losses. It looked like it was breaking out, didn't it? And it did. So as long as you had stops here, you still were in the stock, correct? Now, after a multiple waves up, like 7 waves, which is unusual, and especially with this volume bar here, trading 4.6 million shares in a minute as it spiked up, I told my people, exit 80% of your position. So a little pennant for me.
Hey, Harry, we're just seeing the thank you, the Tech Trader page. We're not seeing a chart.
Oh, no, that's all of this time I've been doing that? All right, let's see what happens.
Yeah, sorry, I just noticed.
I think I'm going to have to share screen, correct?
Yeah, you'll probably have to reshare.
Well, now I don't see it on the share screen. Isn't that interesting? Okay, hold on a moment. There it is.
You might have to scroll.
See if are you seeing it now?
Yes. Yeah, now I see it.
Okay, good. So folks, just to recap real quickly. I came in the morning, I saw a coil. It broke out, we put a buy signal on it, and then it formed a wedge, a little pennant, a larger one, another one, and another one. Meanwhile, all day, all the while, this stock kept trending upward. It never broke support. How do you stay in a trade? Little hint. Once the stock breaks out and pulls back, you see this pullback low, it started to move up again. You raise your stop to right there. Once it pulls down and goes up again, raise your stop to there. Pops up again, raise your stop to there. Notice it never got stopped out, and you stopped it, and you did it again there. Even when it pulled down here, it didn't break out down that low, did it? And you can keep going. But my rule of thumb is you sell in pieces. A third, a third, a third, a quarter, 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 whatever you want to do. But when you reach a certain target, sell some, sell some, sell some. At this point, you should have sold 3/4 of your stock and you're playing with house money, as they say. Now, here's an interesting pattern. This is called a large bull coil. I told my people it's very quiet. Technicals have turned flat. But even though this is a bull coil, it's less reliable. Why? After many moves up, and a move that took the stock from 1 to 3, basically, 200%, this pattern becomes less reliable because it's too far up in the channel after a big move. It's subject to reversal. Well, all you need is one down bar to change the trend, right? One big down bar with volume will do it. See that bar? The increase in volume was the biggest volume bar in a couple hours, or in about an hour. Now, this is what happened the rest of the day with this stock. Nowhere. Very end of the day, I think it curled up a little. No. But the point is, you were stopped out there when you entered there, and you probably sold most of it up in this range. This is why I use pennants, coils, triangles, and uptrends, because they're reliable indicators of an extension of the pattern. But basically, this is a pop and a coil shows the ebb near the apex of the pattern. And what that does, it shows a narrowing of buyers and sellers, and this is where the buyers took over. Buyers took over. Buyers took over. CMAX, different story, but here's what happened. It exploded and pulled back, and I didn't do anything with it because the pullback was too steep. When I see that, I'll keep it on my watch list, but I'm not focusing on it. A few hours later, it's coiling, 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 getting quite narrow right here. Very quiet. Look at the volume, barely existed. Pop and pullback. This is the bar that got me into it. And it popped from 474 to 530 in 2 minutes, right there. Even if you bought it then, literally 8-9 minutes later, from 530, it went up to 673. That's $1.40 in minutes. We do a lot of that at the Tech Trader. That's why I love this kind of stuff. So it pulls down. At this point, this pullback was a falling wedge. This is why I focus on these patterns all day. This is a continuation pattern. The stock moved up, but what was missing here? Low volume. When I see a stock moving up a low volume, it does usually pull back and retest. Well, between now and the end of the day, the stock just went sideways and created another coil. However, if this is a 1, 2, 3, 4 waves, there's a fifth wave missing. This might be a stock to watch for tomorrow. CMAX for a move through 6 3/4 and get up to 8, 8.5. Possibility, we'll see tomorrow. MBIA, check this out. So I come in the morning, this is what I see. That's right, pop coil. That's a bull pennant or coil. It's small enough to be called a pennant. Larger patterns like that are bull coils. It's amazing how people interpret that. I hear that all the time. Now, this is a thin stock, biotech. And how do I know it's thin? Pop, halt, pop, halt, pop, halt. Again and again and again. It's very thin, but from that point there, at $1.80 to $2.90, almost $1, and it did it in minutes with 4 or 5 halts. Yeah, that's kind of nerve-wracking. I will admit that. But what did it do all day? Let's keep an eye on it. Looks to me like another 1, 2, 3, 4. If I look at it the way I normally would trade it, would be this. Looking for a breakout of what looks like a bull flag in the fourth wave. I'm looking for a fifth wave up there, 5. Coils forming, see it? And it's an ascending coil because the bottoms are ascending. So I'm looking for this to break out still until I see an if it rolls over in it. Pop. Right to my target of $5. I lied. 480. If you're scrolling close, you'll see it didn't get to 5. I guess my target was 480, not 5. And I reached my target and then it fell apart. So 1, 2, 3, 4, 5 waves. You got to sell the fifth wave. That's basic LA wave analysis. And that's what it did the rest of the day. Nothing. Here's an interesting one. Over a period of days now. This is a different time frame, but I want to show it to you. Pop coil, a little mini pennant, and then another pop, and what looks like more of a falling flag. But when the breakaway gap occurred, you see what happened. So this is a little different. I'm looking at it from today, just today. It basically broke out of a coil, formed a little bit of a falling wedge there. And when it broke out of that, with volume, it went from 8.75 to 10.25 pretty quickly. Here's a stock we day traded really well today. Where is this? Oh, I see. No wonder I'm missing the rest of the chart. Hang on a sec. SERV. This is what we did with this today. So I came in the morning, it popped the pullback, didn't really go anywhere, it formed a coil. But when it broke out, it formed this little pennant. I like the volume on a breakout. I said, if it breaks out of here, it's a buy. It went from 993 to 1365 in about 4 hours. Notice it never broke a bottom here, here, or here. So if you kept raising your stops like you should have been, if you're good little boys and girls, stop, raise it to there, raise it to there, just keep raising it. At the end of the day, you're still in the stock if you want to be, but there was a 50% move on the stock after forming coil, little mini wedge or coil. There's a mini wedge again. There's actually a little flag in there, if you see it. Viking was a beauty for us. Look at the way this stock formed today. Yesterday, it gapped and pulled back. Today, I'm waiting for the stock in the morning, and it went vertical. I didn't do anything with it, but I saw this 3-wave corrective flag. And then it spiked up and did another 3-wave corrective flag. I told all my people this is going to 70 or thereabout. The high, 69.82, close enough for government work. And now, multi-hour coil is still developing. ASTS, this is another neat one. Let's take a look at it again. The way I love to train or teach is by showing the pattern before and after it developed. So this is from last night. It broke out. Oh, that was last night. This morning it broke out pre-market. Popped, and look at that wedge. This is where I got excited about it. The pop came on big volume. As it pulled back and formed the wedge, the volume was low. It's called the low volume ebb. I mentioned it before. Pop again. And this time, very sensitive chart here. Okay. It popped out, formed a beautiful wedge, you see it? And ran up to my target, which at that time was 15.5. And then pulled back dramatically and spiked up. It got to 16, my target, and blew past that too. Eventually reaching just under 17, 1680. But we broke out, we bought on the breakout at 1430. This is 4.5 points right there. And it only took less than 2 hours. So in pattern recognition, anytime and you know, looking for bull continuation patterns, it's important where it came from, how it developed, and what the first move was. Now, this is the first move here, but it didn't break out. This is where it broke out at 1430, 35. And that's where I put a day trade on. Right there as it broke out. And then spent a little time coiling, retesting. Note that red line, the 50-period moving average is my go-to moving average. And pullback, got to the trend line, lateral price support at the prior high, and the trend line. And then it spiked off of that. This was even a good buy right there at 1530. Why? Well, it went to 1680, $1.50 from about 1040 to about 1120. Not bad, 40 minutes. And for the rest of the day, it just went sideways and consolidated. Could be a great setup for tomorrow. Here's the bottom line, folks. I'm looking for these patterns day after day, minute after minute, intraday, as well as pre-market. Stocks and setups, patterns that indicate higher. Volume that comes along with it. There's something that occurs on TC2000. That's what this system is. I love black backgrounds and colored charts because they really pop out at you. It's easier to see. But one of the keys is an indicator called volume buzz. It tells you at any time during the day what the volume is versus the same volume at that moment of the day, that minute, that second. You know, computers are amazing what they can do. But it'll tell you at that moment in time what the average volume was for the last 100 days and how today's volume compares to that. Whether it's 100% higher, 1,000, and I've seen 10 and 40,000% more volume than average on 10 stocks. There was a stock today that traded 25 million shares and there's only 500,000 shares outstanding. You can imagine how many times that turned over. NOW. And this is service now. You can see last night it popped in coil. That's all I had to go with, pop in coil. When it broke out this morning, that was a buy right there. At 784 is what I put it out. By 1 o'clock, it was 850 for more than 100-point day trade, and it did it in a 1, 2, 3, 4, 5-wave advance. So after 100 points in 5 waves, you're a fool not to sell it. And that's what it did the rest of the day. Pretty much nothing. Another example, Molina Healthcare. Big gap, and this is what we call a flag. Now, in a pre-market pop, I basically anticipated the breakout. I said to everybody, I bet this is a 5 to 8 point trade. I was wrong. It was way more than that. It literally went from 319 to 347.8 range, almost 30 points. And it just kept, all you had to do is keep raising your stop, raising your stop, raising your stop, raising your stop. Here, you would have been stopped out. But look what it did after. So it wasn't a bad move to be stopped out. Or you would hit near the target. I had a target of 348.9. High. I think it was 347, almost 348. So we got within pennies of that being a perfect trade. Here's an example of another stock that started out with a gap, ran up, and then the first 40 minutes or so, first formed the flag, moved up, but there was no volume, and then formed a coil or wedge. There's where the breakout occurred. Notice the volume increase. It ran up, it flagged. It did basically an Elliott wave 1, 2, 3, 4, 5. Another thing I want to tell you about is rule of thumb. If a stock has 5 waves before lunch hour, always exit the stock. Why? Because institutional traders and professional traders that are being paid by the brokerage firm, for example, they may be trading their firm's account, they get paid on the basis of a percentage of their profits. You can bet your booties if a stock is up and it's on 5 waves by lunch hour, and these people are going out to lunch, they're out and celebrating with a few drinks at lunch. But no, the bottom line is amazing how many stocks will have 5 waves into lunch hour and the rest of the day do nothing. This is a perfect example of that. But in essence, what I'm referring to and what I'm looking at is a gap up, which I love to see, either a pull, meaning a spike up in price, or a gap up in price. What follows it is what's important. That's how you make money. Pennants, flags, coils, wedges, they're all important and they occur in multiple time frames. This morning we came in and MLGO was doing nothing. And it did nothing until the market opened, then it spiked. I want to show you this pattern. This is what I saw at the time. A little pennant or a wedge. Volume was very low. What I was looking for was a pop with volume. We got it right there. It was a buy just under $2. Where did it go after that? Kept stepping its way up from 2 to 238. That doesn't sound like a lot, but we're talking about, a 20% trade. And then it can't roll over. Where was the stop in this one? Again, when the stock is trending and that trend breaks, it snaps back to it and fails, starts to roll over. You can sell some as soon as it starts to roll over. Notice that the volume of this run up was not as strong as it was there. You have to stop it under 212. Now let's see where this one went. One more bounce, and then it dropped all the way down to about $1.90. It's really went nowhere the rest of the day. A waste of time and energy. Helmerich and Payne. Check out this start. Very light volume. Formed a wedge and broke out. It formed a little flag in here and just spiked up. And it formed a falling wedge and ran up and formed the flag. So again, what we're looking for every morning is a stock that moves and it moves with it and has these stops and pauses and halts with the right kind of pattern. Most of the time at the apex or end of these patterns, the volume is relatively low. Rest of the day, check it out. Kept going higher and higher and higher. Breaks out of this flag at 40 and a quarter. It went to 42 and a half. Notice also, as I've been saying through every example, and once again, folks, these aren't cherry picked. These are all from today. The stop was there, and then it was there, and then it was there, and then it was there. Still hasn't broken. Pretty amazing move. And again, in a 45-degree angle, stocks tend to move from the lower corner to the upper corner. Some variation of that angle. What did it do the rest of the day? Pretty much nothing. Although, when we consider this large bull flag or coil, little pop after hours. Here's another one to watch for tomorrow. Always look at the daily chart and see where is it relative to prior highs and lows. Is there a lot of overhead resistance up here? Well, I'm giving you targets on this one, for example, on a follow through, it would be 44 and 47, wouldn't it? Makes sense. That's where stocks were at their highs and where people got sucked in or waiting to get. It's so crazy, but people wait to get even. It's like I always tell my people, are you in the stock trading business to get even? No. What you want to do is cut your losses short and let your profits run. You don't want to sit with a stock that's taken days, weeks, and months to recover so you can, quote, break even. It's probably the dumbest thing in trading when people are trying to break even. Either take the profit or take the loss, but never try to break even. Little AMC. Here's what it did today. What would you have done when you came in the morning and you saw AMC sitting there in that pattern? It's a pop and a wedge, isn't it? 485. Well, if the wedge breaks, you want to buy it, especially if there's volume. Look at the volume. Hold on a sec. Volume breakout. Extends and it spikes to my target of 5. Goes back and forms a flag. A large coil. Still flagging. Which way is it going to go? Breakout. Big one. And usually when a stock breaks out above a prior range and holds a high, it's bullish. Doesn't mean it's going to go higher, but I hate this stock. I can't believe Ames. This one is another meme stock. Stitch Fix, very interesting. Take a look. This is why I chose pattern recognition as my indicator. Come in the morning, it popped and pulled back. Often that's dead to me at that point. When it does that again, it forms that kind of, I would call it a sending bull little coil, take a wedge. Take a look. Right there. Wait for the breakout about 440 and be a buyer, especially if there's volume. Up. Right there's the buy. And right to 448, and it ran to 453, and then it went to 456, 460. Now, folks, you're in here at 442, and it's over 462. Now, 20 cents doesn't sound like a lot, but it's 5%, and it's a nice 1, 2, 3, 4, 5 rate trade. I would have sold it. Now, I don't know if it went higher. It might have. Let's see. Still, safety is selling when you have to. When you can, I mean, not when you have to. It worked its way higher, didn't it? And then down. Tucker, Knight Swift. I love this company, by the way. Look at the long-term chart. Big consolidation after a massive move up. I recommended this stock in the low 30s, and it went to mid 60s, almost doubled. But over the last year and a half, it's been consolidating. Well, it's starting to move up again. Today was a breakout, this mini base. See that base? There's your breakout, and there's your retest. If it holds, it starts to go. This will be a buy with targets at 56, 58, and 61. Now, I recommended TSLL today because it's the tracking stock for Tesla. Very popular stock. So you can see it was doing nothing. It popped. I came this morning at Tesla, and this is what I saw. It broke out. It extended. It exploded. It formed a flag. See that flag? And then what did it do? Spiked up to $11, which is exactly my target when we got in around 10.15. So 85-cent trade, you know, 8.5% move. And you know, the market recovered nicely for a time there. Well, it came down and bounced and sharply high so, and then formed the flag. See the flag as it's forming? What would you do here? Would you buy, sell it, or hold? Well, if you're in it, you want to hold it. Where's the stop? I often use this white line, the volume weighted average price, as important support. Price support, about 1084. 1075 was the VWAP, or volume weighted average price. I always recommend the same thing when you sell on the upside. When you stop on the downside. You don't need to stop everything out at once. There are two places that you would have exited the stock, when it broke here and when it broke there. Let's see what happened. You know, the market got killed in the afternoon. This kept going up, breakout. And then late in the day, came down with the market. Nevertheless, we got in at 10:35 and the stock got up to 11:20. Another great example was this morning's, and this is, by the way, a tech trader swing. Folks, you know, I publish not only day trade, but swing trades. When I see long downtrends, and here's a stock that went from 120 down to 1.5, and I kid you not, popped, pulled back, and then broke out with a breakaway gap above the moving averages as they were crossing over. Now, you may remember what I said earlier. One of the best times to buy a stock is after it pops, it consolidates, the moving averages cross over, and then it's on your way. This stock, wedge, retest, ascending bull coil, rising channel. And it's that, you know, it traded 1441 today. And we put it as a swing at 4 in May. On an intraday basis, 1 minute chart, it was also a day trade today. Why? Well, check this out. Pop, coil, pop, flag, pop. Yeah, 1, 2, 3, 4, 5 waves up, exit. The rest of the day didn't do much. And folks, there's a couple dozen examples of what I talk about every day. When you come into my room every morning, I'm looking for stocks that are moving, trending, possibly gapping, and then spend a long time going over all the fundamentals, which, by the way, is the only time I believe fundamentals are important. That's just me. Obviously, people say, well, charts are based on fundamentals. I don't think so. I think charts are based on buying and selling and emotions. Whatever triggers that, whether it's earnings, a contract, FDA approval, whatever it is. I want to know why stock is breaking out and what kind of volume, what kind of average volume, what kind of comparative volume and price we're seeing. I always look for stocks that are up 5 to 10% at least. I want to see stocks that are up 5 to 10% have a chance of moving another 10, 20, 30%. You want to catch it early if you can. You're never going to be able to buy at the low and sell at the high. You want a big chunk in the middle. Well, technical analysis continues the trend and shows you when a stock is ready to extend the pattern. Like I said, I'm a big believer in technical analysis. I have been for over half a century. And I wrote a book called Profitable Day and Swing Trading, based on my knowledge of 1 minute chart patterns and how they can benefit you in your day trading. Once again, I invite everybody that's listening today to come to thetechtrader.com. That's TECH Trader, thetechtrader.com, and sign up for a free 2-week trial. No credit card necessary. Come join us, see what we're doing, see what my style's all about. But if you sign up for a trial, spend the time, get there early in the morning and see exactly what I do. All day I do webinars, live webinars showing you the patterns as they're developing during the trading session, and I'm raising my targets and stops and giving you constant guidance. If you find a person out there that works harder than me in Wall Street, let me know about it, because so far no one has been able to. I'm there at 3:45 in the morning. I'm there after hours. Even I'm there in the evening sometimes, checking on futures and seeing what might be running after hours. So that pretty much concludes my presentation for today. I wanted you guys to get a feel for what I do and how I use 1 minute chart patterns as my indicators to make money and be profitable in your day trading endeavors. This is Harry Boxer wishing you well. Hoping you come join us for a free trial, and I'll see you in the trading room where it all happens. Bye, everybody.